Hello, this is the Core Wealth wrap-up of the financial markets for the month of June 2025. Many of you will be aware that South Africa was grey-listed in February 2023. This meant that South Africa didn't have sufficient controls around financial transactions and the rest of the world therefore reviewed us as a risk. We've just been advised in June that in October, the Financial Action Task Force will come and review the situation in South Africa. This could mean that we get taken off of the grey list, which will be a positive for South Africa as a whole and possibly may even make life a little bit less complicated from a compliance point of view. The inflation number for May 2025 came out recently for the United States. It was only 2.4%, which was a lot better than most people were expecting because they thought tariffs were going to impact that and push inflation up higher. However, what's really happening is that the tariff effect is only expected to come through in the next 3 months, and it could see inflation actually jump quite sharply as those initial effects of tariffs come through. So for now, inflation was good, but it could actually jump quite significantly. The US dollar has weakened by 10.7% so far this year. That's the most it's weakened in the first 6 months of a year in the last 50 years. And this is on the back of concerns around global trade wars, the US budget deficit, and there has been a shift over the last 25 years away from having the US dollar as the main reserve currency. At the turn of the century, it made up about 72% of global reserves. That's reduced to around 57%. Still a huge portion of global trade. So there has been a shift in which currencies are used to do trade globally. One of the big things making the news in South Africa has been how precious metals have been soaring over the first half of this year. And that has impacted the gold shares on the Johannesburg Stock Exchange as well as the platinum miners. This has really been because there's been a shortage of supply and there's more demand for those metals. What we have seen though is that has not fully fed through into the South African mining companies because they haven't been able to get as much of that product to the harbors and ports to send it overseas as they would have liked to because of the problems that we've seen in Transnet. Now there have been improvements at Transnet and that is gradually getting better, but it's still a drag on the mining industry at the moment. So June 2025 was a real strong month in financial markets internationally. What you can see on this slide is that if we just look at developed markets as a whole, up 4.3%. If we look at emerging markets, up 6% for the month. And then you can see the different underlying markets. The Japanese markets really strong, up 6.7%. US markets as well, having quite a pickup, some 5.1% for the month. What I would like to point everyone's attention to is just looking at the last year. Most markets, they're up 15% plus. And if we look over the last 3 years in particular, you can see there that the European equities have actually outperformed US equities over the last 3 years. So it's not just a one-trick story anymore of saying that the US market is the best place to have been. There are different areas around the world that you are seeing value being generated by companies. The South African equity market was also stronger in the month of June. You can see here up 2.4% for the month, and over the last year up over 25%. Listed property also done quite well over the last year and even up to 5 years, but in the month was slightly down. We can see the rand actually strengthened both over the last month and over the last year, some 2.7% stronger over the last year, but weaker against the pound by 5.5% and 6.6% against the euro. And we're seeing now the 5-year number for the South African stock market up 16.4%. So some really good wealth generation that we've seen now over the last 5 years for clients who are invested with long-term portfolios. So let's have a look at how these different markets have combined in our portfolios that we run for different clients. And here we're looking at our US dollar strategies. These strategies now have almost got a 9-year track record. And we can see over the last year some significant outperformance. Our global balance strategy outperforming the peers by 7.1%. That is the outperformance, and the return for the last year has been 16% in US dollar terms. Over the last 3 years, the global growth strategy returning almost 13% per year for the last 3 years. At that kind of return, you're going to see your money doubling in just over 6 years. We're really happy with the long-term track record that we've achieved on these US dollar global strategies. Some of the more recent calls have really added some nice alpha to the performance of our clients' portfolios. Here are our global strategies in UK sterling. This is a much younger strategy, only just over a 3-year track record. But we can see over the last year that we've had some nice outperformance. Some of you may remember that our balanced and growth strategies had underperformed the peer group over the last year at the end of May, but we've seen that turn around. Some slight underperformance over the 3-year period, but the longer term returns of just over 3.5 years now, all of them outperforming the peer groups, and we look forward to seeing that continue into the future. And here we have the South African portfolios, and you can see from the slide a lot of green indicating outperformance of peer groups across all the strategies and over all periods of time, short and longer term. What is really pleasing for me to see is strong outperformance of peer groups, and that resulting in also the absolute return being high at some of the longer term strategies over and around 15%. But what is nice to see as well is things like our flexible strategy and our balanced and retirement growth strategies, all at around 10%, so heading into double digits, meaning that this recent outperformance that we've seen and the strong markets are starting to make up for those soft years during the Zuma presidency, where our markets really went sideways for about 5 years, and we've managed to pick up some of that lost return. What we'd like to unpack now is just the opportunity we're seeing for investments in companies in emerging markets internationally. Did you know that the US dollar has weakened by almost 11% to the end of June 2025, and that this is the second worst first 6 months of the year that we've seen in the last 50 years. The only other 2 times we've seen the currency weaken this much over this period of time was one in 1973, when the US moved away from the Bretton Woods system to a floating exchange rate. And the other time was in 1986, when the G5 countries signed the Plaza Accord in order to try and weaken the dollar after a period of very high interest rates in the US. The strength of the US dollar since 2011 has really been on the back of the strength of the US economy and its relatively higher interest rates than the rest of the developed world. There's 3 things we think could force this to change going forward. The first thing that will change this will be policy shifts in the US. Following the COVID crisis and the Ukraine wars, we saw supply chain issues around the world. In other words, production not being able to carry on in the US because they couldn't get certain components or commodities from around the world because of these supply constraints. Therefore, they would rather produce those things in America. However, it's going to cost more to produce them in America, and productivity is not as high in America. This will be inflationary in the US and could slow down economic growth. The second point is around the changes in the debt levels in the US and how their financial landscape is changing. Donald Trump's big beautiful bill that he's just signed into place, or is busy putting into place, will result in higher budget deficits. This will lead to potentially lower credit ratings, and will mean that the difference in interest rates between the US and the rest of the world again will narrow, which could lead to a further weakening in the dollar. The last point is around the US dollar reserves. China is the second largest holder of US treasuries globally, and having seen what happened to Russia when they started the Ukraine war and the sanctions that were imposed and embargoes that were imposed on Russia, we expect to see that level of holding being less and less. Also, the fact that they funded a lot of those purchases of treasuries from the trade they were doing with the US, with the trade wars, that will likely decrease as well. Did you know that emerging market stock markets, since the launch of this benchmark in 2001, have actually outperformed developed market stock markets over that same period? Emerging markets giving you 8% per annum since 2001 to 2025, and developed markets, which include the US and Japan and Europe, have only given you 6.9% over that same period. Now, while emerging markets have outperformed over that 25-year period, there was a clear inflection point in 2010 when we saw a change in the strength of the dollar. Having a look at this graph, you can see the purple line just shows if it is going up as it did over the first number of years, that is when emerging markets are outperforming. As the purple line starts trending downwards, that means developed markets are growing faster than emerging markets. But what you can see from the green line in this graph is that the dollar really was weakening or flat, and we've just shown it against the rand in this graph. But from around 2010, end of 2010, we saw that the dollar actually started strengthening over the coming years, and that coincided with a weakening in emerging markets. So the next two graphs have a look at real gross domestic product growth or economic growth of different regions around the world. And this first graph, both of them will have a portion in green, which was the forecast that was done in January, and a line or a bar in purple, which is the forecast now in June, so 6 months later. And the main thing I want to highlight, although you can have a look at the different areas, this data is sourced from the World Bank, is that emerging market expectations for growth over the rest of the 2020s is expected to be around 3.8%. This is 0.3% less than it was 6 months ago, while developed markets are only expected to grow at about 1.2%, which is 0.5% less than it was 6 months ago. And so we can see here that there's a real expectation for much stronger growth in the emerging market part of the world than there is in the developed part of the world. Developed markets include the USA. So we've just shown you that the expectation for growth, economic growth in the emerging markets is much stronger than what is expected in the developed world, including the US. But now if we had to buy companies in those different regions, are they cheap or expensive? And this graph just shows you whether the country is at a high rate, their shares are expensive or not. And we can see the orange line here is the US equity markets. We've also included other areas. The green line here is emerging markets, and we can see that's by far the cheapest, both relative to developed world equities, but also relative to its history. It's not looking expensive. And so you're able to buy into regions with strong growth at really good prices. So the dollar has weakened significantly this year. We've shown that we expect that that's probably going to continue. We've also seen that when the dollar is weakening, that is generally good for emerging markets, and emerging markets tend to outperform developed markets during that period of time. We think we're going into such a period, and at the same time, you're able to buy emerging markets at really good prices while we're expecting economic growth in the emerging markets as well. Thanks for taking the time to watch this. If you've got any comments or questions, please leave them below on whichever social media format you are watching us on. If you have any questions for your advisor, please give us a call. We'd love to engage you around that.